No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. All right, we're going to be talking about taxes today. This is a great time of year. You know, in the summer now we're through the tax season. We're not dealing with having to file, but this is a great time to do some tax planning. By that I mean, how can we reduce taxes not only for this year, but for the future as well? So it's a great time to take a look when we're not having that stress of, oh, I've got to get everything done to get in front of to get my tax returns filed and everything. So we've got a great program. It's called Managing the Taxes on Your Retirement Income. This is from the Nationwide Retirement Institute. I've shared this in the past a little bit here and there, but each time we do it, it comes out a little different. And one of the reasons for that is because new perspectives, time of year that you're dealing with, the kinds of things that changes that are going to be coming, and also sharing with you some of the stories, you know, that in working with clients this year, for instance, just talking about some of the things that we get into when it comes to your planning and how the taxes fit into that, and also how your investments, think of it this way, you're going to be retiring, right? The wages go away. Now every day is a weekend and you got no paycheck. Okay, where's the money going to come from to take care of that? Well, of course, it's going to come mostly from retirement savings and 401ks, IRAs, SEP IRAs, whatever, TSP, thrift savings plan for your military and federal employees out there. All the different company plans and individual plans that we may have set up, or just savings that we maybe have accumulated in the bank, all of that, those are resources now to start drawing from. So we've been pumping money in throughout our working years. Now when we retire, we start taking money out, and that changes everything. Okay, it changes how you invest, it changes how you think in terms of your taxes, and just in terms of running your financial household, how that works. So one of the things we do is we try to draw up tax-efficient income plans for clients to help them not only in terms of taking income from those accounts, but how to do so in the most tax-efficient manner. In other words, how about we pay less taxes if we can do it? And that's some of the strategies we're going to share with you today. And helping me with that is my good friend and special guest, Dr. Friday, with Dr. Friday's tax and financial firm over in Brentwood, Tennessee. And Friday, you know, this is one of those times of year, and I know I like to do reviews outside of tax season, where we get to talk about not only the financial plan, but also if there's been any change in taxes. We want to revisit maybe a Roth conversion strategy, talking about taxation of Social Security benefits. It's just a good time to look at everything again and see if there's a way to reduce taxes.
Well, absolutely. I mean, taxes obviously is something I think a lot of times people forget to sometimes budget in their retirement if they're handling it themselves. Sometimes they think about, okay, so I've got, you know, all this money sitting over here and I'm going to get Social Security and I'm going to do this. And in essence, they forget that Social Security can become taxable if they have a pension or if they have a regular IRA or 401k that they're drawing from. Most of that will be taxable. If they sell stock, that can make, so, you know, any of those things can also make Social Security more taxable, up to 85%. So all those little steps have to be kind of pre-done, so that way you know in advance. And you know, tax law says you're supposed to be paying quarterlies. Either you're having money come out of these different accounts, your Social Security, your retirement, or you're sending a check every quarter to the IRS, and it's not really on the quarter, as we all know. The first one's kind of a little wonky because the quarter would think about it would be March, you think, but it doesn't fall until April, and then they catch you up in June. And that's something I think a lot of times, especially people that are in retirement, they think, well, I'm going to wait to the last minute and pay it all at one time. But keep in mind, by doing that, you are going to be penalized. It may be a small amount of money. Some people say, hey, I'll pay the $50 or whatever it is because I could grow that money longer in my pocket or my financial guy. But again, there is a penalty for not making quarterlies.
This is one of the things when you're thinking in terms of retirement and getting ready getting everything ready, some of the things you need to know are some basics about the tax code, how it works, our progressive nature of our tax code, what that means, and what it means to you. And this, when you understand these rules and understand the importance of them, and then also having, when it comes to your planning, thinking in terms of different pots of money, if you will, that I can draw from. So in other words, I've got my retirement accounts, let's say they're traditional retirement accounts that I have been able to put in on a tax deferred basis. Now when I'm taking the money out, I'm of course going to be taxed on those dollars. The other is on a Roth monies. If I've got some money in a Roth IRA, this is money that I've put in, I've already paid tax on. It's growing in a tax deferred basis as well. And when I take it out, as long as you follow the rules, it's going to be tax free when it comes out. So, and of course, the third is just monies that I've accumulated that I've already paid tax on, savings, money that I may have invested in some kind of brokerage account, stocks, bonds, whatever it might be. And that money, like I said, I've already paid tax on, and I'm only paying tax on new income that's being generated from it, or new growth that's been gains, if you will, when I'm selling. So when we're looking at all those three things, that diversification, that's an important thing to have if you can have it.
Right.
And then, of course, we'll talk a little bit about how you can talk to your advisors to help you in doing this. Now, we'll start then. The first slide, Emily, that we'll want to put up there, there are two kinds of taxes on income. If we can get that one on that tax basics, there you go. And Friday, if you'd like to go ahead and comment about the difference between ordinary income tax and capital gains rates.
Right, and it's really important to understand this, because ordinary income tax is basically wages and different types of retirement accounts. So again, when we're talking about Social Security, interest, bank interest, as well as certain types of like 401k. For example, if you're or an IRA, you take money out of those that are just the traditional types, that's going to be taxed at ordinary income, which is why Hank often reviews what should actually be in those types of accounts. Because if you're going to pay ordinary income no matter what, and capital gains rates are lower, there's a game he likes. I call it a game. I'm sure it's a strategy or something very important when you come up to those proper terms. But if you know someone that knows how to play that game, they know where to put that money. It can save you hundreds of thousands over your lifetime. So it's really important to understand ordinary income and what's taxed. And then, of course, we have capital gains. Love capital gains. The other day, a couple days ago, I had a client come in my office, and we were just talking about capital gains tax, and we were in a wonderful position where he was going to be able to be in the 0% capital gains on a sale of some stock, because he came in first, and we were able to calculate how much should I sell today, and then how much should I wait, and whatever in his situation. Now, again, I don't think you should avoid making money just because of taxes. I want to put that out there, because so many people come back to my office and said, well, I didn't sell it because I was, but you don't have, especially in the stock market, right? We don't always know what tomorrow's going to bring. So sometimes people will say, well, I didn't want to sell it because I was afraid of the tax. Well, the taxes at 15% for the majority of people in capital gains is lower than what the loss could have been if you waited to do something. Same thing with real estate sales. A lot of people will say, oh, I'm not going to sell it because I'm going to pay $50,000 in taxes. But wait, you just made more money than you expected in the first place. So keep in mind that sometimes people look at taxes as kind of the evil side, in my opinion. And I think you need to put it in perspective of how much gain did you really get. If you wait, is that gain still going to be there? Because you might save taxes only because you sold it for less. And, I'd rather get 85% of any profit versus not do it at all.
This is, give you a quick example to support that. Think in terms of $100,000. You got $100,000 in that in a gain, let's say. So you were going to sell a bunch of stock because you were concerned it was going to go down, or for whatever other planning purposes there may have been, and maybe you're just taking some cash off the table. So I sell it at a $100,000 gain. I get a 15% tax. That's $15,000, right? Now let's say, that I'm so worried about the tax on it that I'm saying, well, I'm going to hold on, and then, or I'm going to, whatever that planning or thinking might be, and it drops by 20%. Now it's worth $80,000. Okay, so now at $80,000, I still have a tax liability. I've still got 15% now of $80,000, which is $12,000 in tax, plus I lost 20 grand.
Exactly.
So what have I gained here? I'm actually still out, I'm out still way more. That would have been 20 plus the 12 is 32 minus 15. I'm still out 17 grand.
Exactly.
So we don't want to be thinking in terms of first comes the investment conversation, then comes the tax conversation.
Right. There are times when we will suggest different things. For example, maybe it was let's sell up to 100, because if you pop over, then you can end up with additional tax. But I mean, again, that's where the strategy that Hank and he puts together, because you don't ever want to be afraid of taxes, but it must be built in. Because I've had people, the hardest thing I think, Hank, sometimes is people will do their own planning and they'll say, well, you said $100,000, but what they don't take into account is they're getting Social Security, right? And before this sale, it wasn't taxable. But now that they did that, now Social Security, so they've kicked themselves over mathematically because they didn't understand how all of the tax code, the provisional, the capital gain, the ordinary, all came into play. And you really need to understand the whole code, not just one part, capital gains. So it's really important. This isn't something you really want to do by yourself, is all I'm saying, because I've had people that thought they knew what they were doing, and then I tell them how much they own taxes, and they're like, wait, no, and yes, so
that's in fact, just to basically help illustrate that, we'll break it down each of these sections and go into more detail. So starting, understanding the difference between your tax bracket and your tax rate. So let's look at the next slide. This is your 2022 ordinary income tax bracket. So here, Friday, we're seeing basically what the different brackets are, and on this chart, as well as the standard deductions. Now, what we've got in here are standard deductions for those that are over 65.
Okay.
So this is part of it as well. The actual deduction for under 65, I think, is about $1,400 per person on the couple side, which would be $2,800 total, that you get an additional deduction just for having your 65th birthday. Okay, and beyond. And for a single, I think it's $1,750 is added to the standard deduction. But for this purpose, we'll just go within the age 60. So if for a couple age 65, you've got a standard deduction.
$28,700 for the year of 2022. And again, every year that usually will adjust. And then a single person, $14,700.
Now, one of the things, and sorry to interrupt you, but we're going to take a quick break, and when we come back, we're going to delve into this margin. I want you to understand how the progressive system works. And the difference, a lot of times there's a misconception that when you're in a 12% bracket, let's say, that everything is taxed at 12%, and that's or for that matter, a 22% bracket, that you cross over and all of a sudden it's everything. Not the case, but we'll explain how that works after the break. Join us here. We'll be right back on the Retirement Report.